Excellent. Well, it is 1:30 Tuesday, February 2nd. I guess that's Groundhog Day. Um, Seems like we've all been living Groundhog Day for a year now, hasn't it? I want to take this opportunity once again to thank you all for taking the time out of your busy schedules. I know it is RSP season and you've decided to join us for a session here on critical illness insurance, which obviously we're going to tie into your retirement planning conversations with your clients. Just a little bit of housekeeping to get out of the way first. There is a Q&A section on your screen that allows you to post questions to us on the team here. Joining me today is Gordon Chan. He is the Inside Sales Associate for Southwestern Ontario, along with myself, or covering Southwestern Ontario, covering that along with myself and Lynn Giles. I'll tell you a little bit more about that in a minute. Hello to everybody. I will do my best to answer your questions as I go. If I can't answer it, Gordon will. I've got 3 screens going on here. So if I'm looking around, don't think I'm distracted. I'm just trying to keep tabs on everything going on. Wow, great list of attendees. We're pushing 200 so far. So once again, thank you all so very much. You know, it's been a pretty incredible year. On a number of fronts. We'll put the pandemic aside and focus on the wonderful things that have happened at SSQ and La Capitale and now Beneva, for those of you who perhaps aren't aware of our new business name. As I said, today we're going to be talking about planning your retirement with critical illness insurance. I'm going to cover where we are in the current context of both the economic, socioeconomic place that we're in today, but also how your consumers, how your clients are thinking about the retirement and the risks and concerns and fears that they have, both during retirement and even leading into retirement. We're going to talk about how critical illness plays a role in that part of the planning cycle, and then I'll highlight some of the unique features and benefits of our product lineup. Before I get into the presentation, though, as I said, it's been quite a year for us at SSQ and La Capitale. As I hope you're all aware, we merged last summer, officially July 1st, to become the largest mutual insurance company in Canada, with now 5,000 employees across the country. We are the 6th largest insurance company in Canada, only looking to grow. We've been setting a great pace over the last 8-9 years now since we've been in the brokerage market. We are continuing to grow assets, and with our newfound partnership with La Capitale, we are very excited for what the future holds for us. As far as you're concerned, though, as advisors, very little is going to change this year. You're still going to submit business to both companies the way you would have done so in the past. The products are staying on the shelf, as far as we're aware, for at least the balance of this year. The only notable thing that's changed for you would be the wholesaling teams and how they've been realigned all across the country, and contracting. That was the other thing. Contracting is probably the only other thing that you should take note of. If you've been contracted with either of our 2 companies, La Capitale or SSQ, for at least 2 years, we have a simplified contracting process for you to go through in order to make it just easier for you. If it's been less than 2 years, then you'll have to go through the traditional contracting process with your MGA. But if you have any questions about that, feel free to reach out to any of us on the wholesaling team or your MGA, and we'll be happy to help you with that. As I said, we have realigned our wholesaling team all across the country. It's funny, we used to all fit on one page on a slide, and now I've got 3 here. I'm certainly not going to introduce everybody. Most notably, I think if you're in the Ontario region, there have been some significant changes to the team and the territories that we're covering. This presentation is being recorded. It will be available for you. The slides will be available for you. So if you don't have the contact information for your local wholesaler, we'll be able to get this to you within short order, and you'll have all of that contact information. But if there's somebody that you'd like to reach out to in the meantime, in the short term, feel free to type it in the Q&A section, and either Gordon or myself will respond to you. So as I said, my name is Sean Redford. I've been in the industry for 26 years now. I just celebrated just over a year with SSQ back in November. And as I said, it's been a remarkable year with the merger. and a couple of the other things I'm going to talk to you about in a second. For those of you that are in the West, this is your wholesaling team in BC, Alberta, the Prairies, and Quebec team. As you can see, we are quite a large organization all of a sudden. And I think it's a good time to introduce this for those of you who aren't aware, and that is that last June, our CEO for SSQ and now the new CEO for the merged company Beneva, was named the chairman of the board of directors for CLHIA. And, we're very proud of this as an organization. It really is a testament to what our organization has accomplished, not just over the last 75 years, but what we've done since entering the brokerage market in 2012. So kudos to Jean-François Chalifot for that position of distinction. As I said, we're extremely proud of that. Another thing we're very proud of is last June, we launched a new simplified and guaranteed issue product. It's the newest in the industry. And I certainly wish I could spend more time going into the details of this product today, but I'll leave you with 3 points to remember. And as I said, if you want to know more information, you're welcome to contact us through the Q&A section. We'll be happy to arrange time to meet. The 3 things that you need to remember are, in terms of pricing, we offer banding on this product. And so if you're looking at coverage for more than $100,000, what you're going to find is we're going to be anywhere from 20 to more than 50% cheaper than comparative products in its class. So first and foremost, you'll obviously be doing right by your clients by looking at this product from a pricing point of view. Second, from your perspective, we've priced it, or rather we've remunerated or set the commission structure for these products the same as we have for our traditional products, which for you means for T10 or T20, you're going to get paid substantially more, and upwards of 25% more compensation with this product than you're going to find elsewhere. So there's 2 reasons for you to consider the product. The third being really what makes it truly unique, and that is the speed. From the time that you go through the application with your client online, it's only available through eApp, but from the time that you go through it with your client to the time the client delivers or receives the delivery of that policy, it's less than an hour. And in fact, I was on a call with an advisor helping navigate through the actual application with the client, and before we hung up the phone with the client, they already had the policy delivered to them. It was in less than 15 minutes. So whether it's the price, the compensation, or the speed that interests you, it's definitely something that you're going to want to look at before you look anywhere else for those 3 reasons. So if you want to know more information, please feel free to reach out to our team. The last thing I'm going to highlight for you is it is RSP season, and what we're offering is a promotion right now on our 18-month Select GIA, and that's 1.25% interest until March the 1st. So it's until the end of RSP season. Your clients have access to this incredible rate on an 18-month GIC. So make sure that you talk to your clients about that, regardless of whether it's TFSA or RSP. All accounts are eligible. All right. So let's get into the meat of the presentation today, the current context. Where are we today? What are retirees looking at when building their RSP portfolios, when navigating their RSP accounts? I think it's funny, I've been presenting in one form or another for over 20 years. And it seems like for the last 20 years, I've been saying the same thing, that stock markets are unpredictable. We saw it with the tech bubble bursting in the early part of the millennium, and then the mortgage-backed security meltdown back in 2008. And there's always one thing after another. The recent roller coaster that we've been through, whether it's American politics or the pandemic, there's been a lot of uncertainty in the market, and it's led to increased unpredictability. Not to mention what we just went on last week with day traders. So that's not going to change. The other thing that hasn't changed in the last 20 years is interest rates have reached historical lows. And they really can't go any lower, but we've been saying this for a very long time. It seems to be the case. And why is this important for retirees? Well, historically, retirees tend to put less or invest in less risky investments, fixed income investments, which are very much interest rate laden. And as a result, with low interest rates, it's forced them to look at more aggressive investments than they might otherwise want to, just because they need that yield. They're looking for that return on their investment so that they can sustain their lifestyle throughout retirement. The third thing is life expectancy has increased considerably, and it keeps increasing year after year. I think it was just a year or two ago, I heard a stat, and that was that somebody that was 40 years old, let's say 2 years ago, was going to be the first person to live to 150 in the world. Somewhere in the world, there was somebody 40 years old that they expect to be the first person to live to 150. Talk about longevity. And it's important that we talk about life expectancy, because that's really the underlying reason why critical illness insurance was created in the first place. I'll talk more about that a little later on in the presentation. But the fact of the matter is, these are all serious concerns for retirees and pre-retirees as they navigate their retirement plans. And it's your job to manage those expectations. Now, there's an old adage on Wall Street that claims that there's only two factors that influence the stock market, and that's fear and greed. But in recent years, there's been changes to those models. And, the economic theories and models of the past are really holding less weight than they used to. And a lot of it has to do with the evolution of behavioral science. And there was a psychologist, Daniel Kahneman, and economist, Vernon Smith, who won Nobel Prizes in economics back in 2002, that demonstrated that the old rules of investing and economics aren't exactly holding true anymore. And again, I'll be talking about that in a little bit as well. I'll give you an example, though, of one of these irrational investment theories that Dr. Kahneman discussed. And the example on the screen here that you'll see is that with an initial investment of $1,000, which of the two funds below would accumulate more value after 10 years? Now, understand, consumers won't usually whip out their calculator and do the math and figure it out for themselves. They'll look at or listen to what it is that you present to them, and they'll make their decisions based on that. So the example here that you see on the screen is Fund A has an initial 10% drop and then 2% growth per year over the next 10 years. Whereas Fund B has an initial drop of 50%, but 10% growth for the next 10 years. When given these choices, most people are going to choose Fund B with the 10% growth for 10 years. Dr. Kahneman's research found that losses cause a greater emotional impact on the individual. So they will instinctually choose the option offering the most perceived gains. And on paper, looking at this, without doing the math, most consumers would look at the 10% growth and assume that over a 10-year period, they'd be far better off. I mean, do the math. 10% drop, put that aside for a second. 2% growth for 9 more years would be 18% simple growth, versus 10% growth for 9 more years is 90% growth. You would expect that to be bigger. Well, I think you probably guessed it. Fund A actually would have been the better choice because of a smaller loss in that first year. And this is extremely important for you to take into consideration when you're building retirement portfolios for your clients. The risk of loss is much more impactful to somebody who is no longer contributing, or worse yet, starting to withdraw funds from their investment portfolios. But there's also a significant impact in those pre-retirement years, in those years leading up to the retirement, those last 5 to 10 years. The impact of losses then are also significantly magnified versus if they were to happen earlier on. So the reason we're talking about this is that these are conversations that you have to have with your client. You need to educate them, but also understand their emotions and what's motivating them and what is going to be on their mind. And that is more the fear of loss and the perception of gain. So when you're talking to clients, you need to be clear and to discuss both the risks of gain or potentially losing out on some gains, and that's okay, versus the risk of loss. Now, beyond fear and greed, there's also pride and regret. And the question is that you need to be talking to your clients about is, what is the benchmark that they're considering as important for them when they're comparing their portfolio to whatever that benchmark is. So what is the benchmark? Because the choice of the benchmark is very important, and it's important that you understand what that is. So what are the possible benchmarks that your investor clients are likely to use? Is it the purchase price that they initially bought the product or the fund at? Is it maybe the lowest point that that portfolio fell or that stock fell in the year prior? Or the average price, or the highest price? What is their benchmark? What are they comparing themselves against? And here's an example for you. An investor buys shares of ABC fund for $50, and a year later, he sells it for $75. During that time, the price of the share peaked at 100 and reached a low of 45. So at one point, that client could have sold and doubled their money, or they could have sold at a loss of 10% at one point in time. Does this investor feel like they've made a profit or a loss, though? Because if their benchmark isn't the initial $50 purchase price compared to the $75 sale price, if it's the peak of the market, then they're looking at this as a loss. And it's important for you to understand that emotional concern of theirs. And that's why it's so important for you to know your client, clearly outline and identify the goals, regularly communicate with them, and most of all, advise and educate them to avoid irrational decisions. The fact is, we're humans, and we're often irrational when it comes to investing. I'm sure we're all aware of that. We allow fear, greed, pride, and regret to impact not only our decisions, but our beliefs. So these conversations on a regular basis, if you're dealing in the investment market, are extremely important for you. So what are retirees fearing? I don't think this will be a surprise to you. Their biggest fears tend to be losing or outliving their savings, the unexpected expenses that come out of nowhere. And that could be any number of things, having to replace a vehicle, do work to their home, or heaven forbid, deteriorating health. And the consequences of that, are they going to have to retrofit their home? Are they going to need in-care support? How are they going to fund these things? These are some of their biggest fears. Now, what about their investment portfolio itself? How can they lose their savings? What are some of the impacts on their savings? Well, obviously, poor investment performance. If they're only yielding 2 or 3%, but they're taking 4 or 5% out of their portfolio every year, obviously that's going to erode their savings. Falling stock markets during that payout period are a dramatic draw on a savings portfolio, and they need to be watched very closely. As we already talked about, unexpected expenses and healthcare costs that aren't covered are also big concerns. Another example here that I'd like to share with you is something that actually happened, and unfortunately could happen again and probably will. In this example, a month after retiring, this individual took a 50% loss to his savings after buying Nortel shares. That happened way back in 2000, and it very well could happen again. And that sequence of returns or sequence of, the sequence of returns when people make or lose money is extremely important, especially in the beginning stages of that retirement income draw period. As you can see on the screen here, a 10% loss requires an 11% recovery just to get back to break even. That doesn't even account for money that might have been taken out of the portfolio or the loss of return that you would have expected to have happened in that year when you were perhaps planning for an average yield of 4, 5, 6% a year on that client's portfolio. When they lose 10% in that first year, they're very far behind the 8 ball. And that's why it's so important when you're building portfolios to make sure that you have that fixed income component where you can draw the income from while not having to touch the part that's being invested in the market for fear that the timing might be bad. So proper diversification in your portfolio is absolutely key. Earlier on, I was talking about Dr. Kahneman and his partner, Ewas Tversky, who created the prospect theory. And this is what won the Nobel Prize back in 2002. And the theory really sums up how your clients feel emotionally about the performance on their investment portfolio and how they feel differently specifically about gains and losses. And the theory is that consumers feel losses and gains very differently, and that they make decisions based on their perceived gains instead of perceived losses. And what do we mean by that? The theory is that losses cause greater emotional impact on an individual than the equivalent amount of gain. As you can see on the graph here, this individual, let's say X, represents a 10% gain. X also represents a 10% loss in this graph. But the dramatic effect that that loss has on the individual, the usefulness, that feeling of emotion that they have with that loss is far greater, sometimes 2 or 3 times greater than the equivalent amount of joy that they would feel for the exact same gain. So the reality is investors focus more on the conversation that revolves around growth potential when you're talking to them than the chance of loss. So it's so important for you to convey properly and concisely the probability of gain and loss when you're having that conversation, despite the fact that they react or feel disproportionately to losses than they do gains. You still have to have that conversation. Now, your risk managers, it's one of my favorite titles to give insurance licensed professionals. I stole this from an advisor, I don't know, well over a decade ago. And on his business card, he actually called himself a risk manager. He didn't call himself an insurance advisor or financial advisor or insurance agent. He was a risk manager. And the reason he said that is because he said, I'm the professional that you deal with, not your accountant, not your lawyer, not your, any financial, even any professional for that matter. I know more about you than anybody else. I know your fears. I know your hopes. I know your health. I know your income. I know your taxes. I know everything about you personally, professionally. And it's my job to manage all of the risks that you aren't even aware of. And in my role as a licensed insurance agent, I'm able to protect more risk than any other financial professional that you're ever going to deal with, just by virtue of having that life insurance license. I can manage investment portfolios. I can diversify risk, as you can see on the screen, with asset class or geography or by industry. We can talk about tax efficiency. We can talk about dollar cost averaging. There are a number of things that I'm able to help you with in managing your retirement income goals. But what we still find is, as we approach retirement, as we are in retirement, we become more and more risk averse. And so what we find are, more often than not, retirees gravitate to more secure investments. They want guarantees, whether it's from GICs or GIAs in the insurance industry, segregated funds. These protection measures give them a sense of security that they wouldn't otherwise have. But we're talking today about the topic today is supposed to be about critical illness insurance, right? So where does life insurance and CI fit into this conversation? Well, are you having a conversation with your clients about the possibility of a disability or a life-threatening illness? I'm not going to talk about life insurance and how insurance can play a role in planning, for the reason of time. I don't have enough time to get into it. Today, we're going to focus on the critical illness insurance aspect. And so the question that you need to ask your clients is, what would they do if something were to happen to them before retirement or even in retirement? How would that impact their financial situation? I'm sure you've seen this or something similar in the past. These are two individuals. Individual A, they're both investing the exact same amount. They started with $250,000 by the looks of it on the screen. They were investing $1,000 a month, I believe, every year throughout the years for the 20-year period all the way up to age 65. And if everything goes right, they'll have $1 million saved in their portfolio. And let's assume that that's enough to sustain them throughout the retirement. Well, what if in year 10, that individual were to suffer a critical illness and require $50,000 to be withdrawn from their RSP or RIF, I guess in this case, an RSP, from their RSP portfolio? What would the impact be on that portfolio? Well, as you can see, first of all, they'd have to take out $87,000 if they're in a 43% tax bracket in order to get the $50,000 out of their portfolio. And although they've taken out $87,000, the impact of that loss over that remaining 10 years, it's only 10 years, will lead to a shortfall of $167,000. So if this were the case, this individual, we'll call them person B here, who retires with $843,000, what are their options at retirement? They can either reduce the income that they expected to draw through their retirement years, or they can increase the risk of their portfolio in those remaining 10 years to try and make up the difference. Or maybe they have to work 3 more years, none of which would be a pleasant conversation to have. So when you're having conversations with your clients now during RSP season, it's probably an opportune time as their risk manager to ask them the question, could you afford to take an indefinite amount of time off work? When was the last time? This is one of my favorite Keith Leach questions. If you don't follow Keith Leach, as far as I'm concerned, he's, the living benefits guru now in terms of marketing living benefits products in Canada these days. So Keith Leach's question was, when was the last time you took a 4-month unpaid vacation and you didn't tell anybody that you were going to do it? You just did it. Probably never. And there's a reason for that. It would have an impact on your business, your job, your family. So it's time, and it's your responsibility, risk managers, to talk to your clients and ask them, could they afford to take an indefinite amount of time off? How serious would that eventual financial impact be? Would it impact their retirement savings? Would it impact other financial goals that they have? Could they continue to pay their bills short term despite the additional expenses? Could they continue to save in their RSP if something were to happen? Would they be able to afford treatment and all the necessary care? It's not a pleasant conversation. Nobody likes to have it, but that's what we do. We encourage our clients to have these conversations as their risk managers. Now, what are some of these unexpected expenses? Well, public and private facility care is extraordinarily expensive, if necessary. Medications, it's staggering to see that 70% of cancer-related expenses aren't covered by the province. So, and I actually remember having one client of mine back, it would have been about 20 years ago. He was paying $3,000 a month for an experimental cancer drug that wasn't available here. It was available in the States and covered under benefit plans in the States. But here he was having to pay $3,000 a month for that treatment. Thankfully, everything worked out for him. It was well worth the investment. But imagine having to come up with $3,000 a month. I don't know many people that would be able to do that. And goodness knows what other expenses. When we first started talking about CI products 20, 25 years ago, and shame on us. But at the same time, I should give us a little bit of credit. The product was still new. We didn't have the claims experience that we have today. We didn't realize that people would be using critical illness insurance proceeds for much more than jumping the queue and going down to the States to get treatment, or for covering these, uncovered expenses. Today, 20, 30 years after this product's been, actively sold and available in Canada, we're finding more and more that families use these proceeds to replace a spouse's income or cover the expenses related to getting treatments, staying in a hotel. I actually had an advisor diagnosed with cancer. He was based in Windsor, and he would have to make regular trips up to Toronto to I think it was St. Margaret's Hospital, or Princess Margaret Hospital, rather, for treatment. And the cost associated with doing that was very expensive. And he certainly didn't want to be traveling back and forth. So, he ended up renting a place in Toronto. He was able to do so affordably without impacting his life otherwise financially because of his critical illness insurance. So it's important to understand and be aware yourselves of all the different ways that people are using or can use the proceeds that come from a critical illness insurance claim. Let's talk briefly about statistics. And I say briefly because I still believe our industry continues to do a disservice to you advisors, getting you to sell this product with statistics, because consumers know statistics can be manipulated. They don't inspire people to act either. From my experience, what inspires people to act are people, are stories, we need to become better storytellers. You need to ask your prospect to tell you stories about their friends or their family members who've gone through one of these life-threatening conditions. They were one of the statistics, and it just brings more reality to the conversation. Because again, statistics, 25% of men, 50% of Canadians, it's white noise. We are inundated with statistics all the time as consumers, and we don't pay attention to it anymore. But what we do pay attention to are stories. I've started sharing this slide and this kind of discussion point with advisors when talking about critical illness insurance for the last, probably 3 or 4 years now. And it all started the first time when a friend of mine posted on Facebook a GoFundMe link because they had a family member who was diagnosed with cancer. And I would hope your reaction would be the exact same as my initial reaction was. And it was, I didn't do my job. I didn't make them aware that there was another option available other than relying on the goodwill of their friends and family members to donate to their need, as opposed to being able to educate them on the fact that there is a product that really, for pennies or dollars a day, would have provided them with resources to be able to deal with their life-threatening illness themselves with certainty and independence and control, rather than having to hope that somebody else is going to do it for them. And if you see on the screen here, what it says is, all I did was I went to GoFundMe, and in the search box, I typed in cancer. And I've been doing this, as I said, for a number of years, and there's always hundreds of thousands. In this case, you can see 981,000 posts just for cancer on GoFundMe. And that's a sad testament when there is another alternative. And, even today, the market and our industry has evolved quickly in this regard, very slowly in others, but in this regard, you can even get guaranteed issue critical illness insurance in the marketplace today. Regardless of your health, it's available to you. So there really is no reason. Everybody is eligible. And I guess I'll take this opportunity to do a little plug for our CI rider. And that is that when you buy life insurance with SSQ Insurance, if your client is approved standard or better, they're automatically approved for our CI rider. Now, some of you may think, well, so what? If they're approved standard for life insurance, chances are they'd be approved for CI as well. Well, I'm sure many of you are aware that that's not the case. Things like family history play a big part in somebody's ability to qualify for CI. Most companies have different build charts for CI than they do for life insurance. There's obviously different criteria that goes into underwriting somebody for CI than there is for life insurance, which does make it harder to qualify for. So if you're one of the fortunate individuals who chose to work with SSQ Insurance and got approved standard, despite the fact that maybe their build was a little higher than average and maybe they're a type 2 diabetic, they were still able to get that coverage on a standard basis for life insurance. Well, we'll also give them $20,000 of CI coverage. The covered conditions are cancer, heart attack, and stroke, which, I don't know, I hear the numbers range anywhere from 87 to 92% of claims are those 3 conditions alone. And another great benefit of the product is that the premiums stay level all the way to age 85. So it's extremely affordable. At $20,000 of coverage, some might say that's not enough coverage. I guarantee you $20,000 of tax-free cash at a time when you need it the most would definitely be welcomed, and you would definitely be appreciated for the work that you did and the value that you brought. So I think we've answered the question, which product can provide guarantees and protect your client in the event of a critical illness? Well, there's obviously critical illness insurance. And as I said earlier on, life expectancy really was the driving factor behind why this product was created. And I think we often do ourselves a disservice as well when we're presenting CI to our clients in not telling them about the history. So the CI conversation should, in my opinion, include these 3 points. First, a conversation about Dr. Marius Barnard and the fact that, his point behind creating this product was that medicine and medical advances were helping people survive what were once deadly illnesses. They should have died from that heart condition, but instead we're giving them a brand new heart. Surviving that illness was putting patients in financial hardship. I mean, I don't think there's anything worse that a doctor would like to hear from a patient than, I wish I had just died because my family would have been better off. But the fact that I had to take 6 months or a year off of work, I ended up not being able to go back to that job, or I lost my job, or whatever it happens to be, would be a very dramatic or detrimental thing for a doctor to hear after they just saved that person's life. And the reality is, and this was Dr. Marius Bernard's final point, and that is that financial hardship causes stress, and stress impedes and affects your ability to recover. And thankfully, it was a doctor that created this product and not the insurance industry, because if it were the insurance industry, I'm sure this product would have been created the same way as disability insurance. And claimants would have had to have submitted receipts for everything that they've had to pay for, and then they would get reimbursed for it. And they'd have to continue to show that they were still unable to go back to work. Well, that wasn't Dr. Barnard's idea. He said, why don't we just give them a lump sum of money that would help them deal with whatever their financial hardship happens to be, and give them control over their recovery, that independence and choice that I talked about earlier on. The next thing that I encourage advisors to do is the 4 key questions that, again, I learned this from Keith Leach. He's been talking about this for 15 years or so now. 4 key questions to ask your client, to create a dialogue, a conversation with them, to get them opening up and telling stories so that you can avoid talking statistics with them. And then finally, attach value. So let me go through the 4 questions with you first. So the 4 questions are, do you know anyone who has suffered from cancer, heart attack, or a stroke? And then, forgive my language, but just shut up and listen. Let them tell you the story of what it was that they had to go through, those individuals. In doing so, your client is inevitably going to start thinking about how it would impact them had it been them instead of their friend or family member that suffered from that ailment. The next question is, were they prepared for the diagnosis? Did they expect to get cancer? And most people don't. And that conversation helps deal with the objection, it's not going to happen to me, because nobody thinks it's going to happen to them. So, were they prepared for it? Did they have coverage in place? Had they had conversations with their loved ones to talk about how they would deal with it? Were their expenses manageable so that they could afford to not have their full income for 3, 4, 6, 12 months, however long it happens to be? The next question is, did they, their family, or their business suffer emotionally or financially? I'm sure the answer 100% of the time is yes when you're asked about the emotional impact. Of course it would. But financially, maybe not. You know, this is a tougher conversation, or a more detailed conversation that you're going to have. What possible financial hardships did they face? And then finally, could cash have helped? Could cash have helped to pay for your spouse to fly in from, say, BC? And that spouse of yours has been your rock all your life, helping you get through challenging times. And there's nobody in the world you'd want more than your, sorry, I think I said spouse, but I meant to say your sibling. If your sibling lives elsewhere, you know, how great would it be to fly your sibling in, to drive you to your appointments, to stay by your side? Because let's face it, most of the time in a relationship anyway, your spouse is probably going to have to continue to work to continue to generate income for the family. Or maybe that's the reason why you would buy the critical illness insurance. I remember that was the first reason why I bought it for myself, was because I wanted my spouse to be able to take time off and take care of me. I'm a guy, I'm a suck. When I get sick, I want to be catered to. I want to be taken care of. So, you know, buying enough coverage so that my spouse could take time off of work and we didn't have to worry about her income, that gave me financial peace of mind. And the last thing I talked about was attaching value. When you're having the conversation with your client, it's important for you to remind them that this product doesn't just give them cash, but it gives them all the things that you can see on this screen here. You can talk to them and remind them about why the product was created by Dr. Barnard to help reduce stress. And by alleviating some financial burdens, undoubtedly that's going to relieve some stress and help you in your recovery. But it also gives you choice. It gives you the choice to deal with your recovery how you want to, or the choice for different treatment options. I had another advisor whose daughter was diagnosed with cancer. And because of his $250,000 CI policy, he was able to afford to fly her down to Texas for experimental treatment that was being done down there. That choice, that independence, you can't put a price on. And the one last thing I'm going to talk about with regards to options and choice, and something that comes with every CI product, at least every one that I'm aware of in the marketplace today, are these second opinion services, whether it's Best Doctors or Advanced Medical, or at SSQ, it's the AXA assistance benefit. That second opinion provides a lot of peace of mind to the individuals. And I've had firsthand experience with this. I had a very good friend and work colleague who used it for his daughter. And within a very short period of time, 2 or 3 weeks, a 20-page report was sent to him from 2 independent doctors in different parts of the world who verified the diagnosis, the treatment recommendation, did everything or had very similar thoughts on the condition. But both of them independently said there's one doctor in Canada that you should use for this treatment. And what do you think that father did for his daughter? He got that doctor to perform the surgery. It took a couple extra months, I believe, but he was able to get that doctor to perform the surgery. The peace of mind that that free benefit provided was worth more than the CI benefit itself. So don't undervalue the importance of that benefit. And some benefits are better than others. I'm quite proud of the one that we offer, the AXA assistance benefit. It goes far beyond a second opinion service. It offers legal support, so you can call if you've got questions relating to estate or real estate or family law, identity theft protection. You can even get up to $750 a year of psychological benefits to top up maybe what your group benefits don't cover. It is an incredibly valuable service that's included as part of the living benefits package. So don't undervalue that. Our critical illness insurance product is very robust. I talked earlier on about our CI rider, but I don't want it to be confused with our standalone CI product, which can also be added as a rider in order to save policy fees on any of our underlying insurance products. So the plan that we offer includes a basic option, which covers 3 conditions: cancer, heart attack, and stroke. The enhanced, which covers the 25 major conditions that most carriers are dealing with today. Yes, it includes loss of autonomy. I get that question all the time. For children, there are additional coverages that are included. You've got the choice between short-term durations. You can go with a T10 or a T20, or you can go with a T75 or a T100 if you're looking for a permanent solution for your clients. We offer banding, obviously, early intervention benefits as well. And as I said off the top, of this slide, or where I ended on the last slide, the assistance benefit is an incredibly valuable resource and something that you should always talk to your clients about. ROP options are also available. You've got ROP on death, expiry, and cancellation. As you can see on the screen, the ROP on death is available for all plans. The ROP on expiry is only available on our T10, T20, and T75 product, whereas the ROP on cancellation is only available on our T75 and our 2 T100 products, the 2 being a life pay and a 20 pay T100 product. What else did I want to cover? I'm going to show you just one more idea before I wrap up and open up the floor to questions. In this instance here, the question that some consumers debate, especially advisors. Your clients have a fixed budget, and we can appreciate that. So we don't want to have a conversation where you're comparing or deciding between, should I buy CI or should I buy or invest in my RSPs? I'm going to show you a way that hopefully we can do both. But before I do, I'm just going to highlight for you the affordability of CI coverage. And especially in this case, I'm highlighting our T100. And why am I talking about our T100? The reality is because we're talking about retirement planning today. It's RSP season. We're talking about how retirees are concerned about unexpected expenses coming when they don't have the means or the resources to build up that retirement nest egg anymore. So as soon as possible, buying that permanent plan can add a lot of peace of mind and protection to your clients' retirement portfolios. And as you can see on the screen here, a 35-year-old, if you can get them at 35 to buy this T100 product, and in this instance, it's a 20 pay. So before they're retired, this is all paid up, would only cost them $2,000 a year, including all the ROP provisions. And that's for a male. For a female, it's going to be slightly cheaper. So still absolutely affordable. And you don't have to apply for $100,000. I think this is a common issue and concern that most advisors have, is it's not quite as black and white determining the need for CI as it is with regards to life insurance, because the questions remain: how long am I going to be disabled? I don't know what treatments I'm going to want. I don't know how much coverage I can have. But my answer has always been this: start with something. You can always add to it, assuming they're insurable, but at least they'll have something available at a time when they would need it the most. So I'm going to go back to the example I used earlier on. Had this individual purchased a $50,000 CI plan, instead of there being a $167,000 shortfall at retirement, this individual would have had a $50,000 CI claim paid at year 10, which would have alleviated the loss and kept their plan on track. That's, I think, the conversation to have with your client. Which would you prefer to deal with? Would you rather run the risk of having such a shortfall, or is there a way that we can protect against this risk by putting a CI policy in force and understanding that if you're fortunate enough not to have a claim, you can still get all that money back? Yes, you get paid for this product. This slide probably should be somewhere else in the presentation, but I'll highlight it now anyway, since I'm here. The FYC on our T10 is 45%, 50% for the rest. You've got lifetime renewal premiums on the plan for 2% long beyond the 10-year period. And renewals on our T10 or T20 are 15% paid to you. The riders obviously also get paid, whether it's the child rider or the RLPs. You're obviously going to get paid for those as well. But this was the strategy or the concept that I was talking to you about a couple slides ago. Is it better to buy CI or just contribute to the RSP? And what I'm going to suggest is, why don't we do both? And how can we do both in a way that's affordable to the client? So in this example, we've got a 35-year-old male non-smoker, and 7% is the rate of return on this investment portfolio. And what we're looking at doing for this individual is continuing to contribute the $2,095 a year that they're putting in. After 20 years, there's $91,000 there, or contributing to a CI policy. So if they don't have CI coverage, what would happen? Well, this is how their portfolio is increasing over time. $12,000, $30,000, $56,000, $91,000 is what's going to accumulate. If there is no claim, then at the end of the 20th year, which is the earliest time that you are able to cancel our policy to get your return premium back, you'd have $15,000 paid to you. With a critical illness insurance claim, at any time, you'd have the $100,000 plus your savings still. So how can we structure this? Well, what I would suggest is this. Why don't we take the savings, the tax savings from that RSP contribution, the $778 in this instance, and allocate that towards however much CI you can purchase. Now, in this instance, it would be $31,050 is what $778 would afford in terms of CI coverage. And the return in premium at maturity would be $14,000. So now let's see how the scenario plays out. Well, in this instance, with the combination of the two, at the end of the 20th year, if there was no claim, your client has the option to surrender the policy, though I wouldn't recommend they do it, but let's assume that they do, then that $14,000 can be either added to their RSP prior to converting it to a RIF, or maybe they can top up their TFSA, pay down their mortgage, pay off some debt. Who knows? They've got that choice and flexibility that we were talking about earlier. If there is a claim, well, then again, they've got the benefit of that $31,000 of tax-free funds coming in that they can use however they wish, plus their $91,000 of savings. Maybe for that 1 year or 6 months or 4 months that they had to take time off, they were able to continue to put money into their RSP as they had planned to do. They were able to deal with their recovery in the way that they wanted. Maybe they were able to cover their mortgage expenses. Who knows? But that $31,000 can go a long way. Imagine somebody is off work for 6 months, $31,000. That's $5,000 of tax-free money every month coming into the household. That, I think, would make a significant difference to anybody. That is the presentation. I hope you got some ideas, whether it's how to improve your conversation with clients regarding critical illness insurance. Maybe it's the concept of using the tax savings from the RSP contributions to fund the CI coverage. I'm welcome. I'm going to hang around for at least 15, 20 more minutes to answer any questions that you may have. But before you all depart, I just wanted to once again thank you for taking the time out of your busy schedules. Wish you all a happy new year. This is the last time I'm going to say happy new year, seeing as it's now February. And I want to wish you all a very safe and healthy 2021. We are very much looking forward to seeing you in person sometime in the very near future. So, thanks again. CE credits in this presentation will be sent out in the coming days or weeks, depending on how busy our marketing team is. So please be patient. But if you've got any questions, feel free to reach out to anybody on the sales team. And now I'm just going to go to these questions. Thank you again, everybody. Emmanuel asked, the automatic qualification for CI by an applicant who was approved regular for death coverage, life insurance, is a superior benefit to consumers, as noted in Life Guide. Excellent. Well, thank you. Thank you for that. There wasn't a question there. It's a great comment, though. Thank you for that. Rita, I was under the impression that it would be for actual retirees. For 50,000 of T10 of T100 for CI, it is $286 a month. It's quite a big chunk for a retiree's budget. What would you recommend if this is the situation? You know, you're absolutely right. Well, I don't know what age this is, because most retirees, unfortunately, wouldn't be eligible for CI. And that's why it's so important to have these conversations early as possible, to make sure that you can put these plans in effect. But you're right, $286 a month is a lot. And if it's too much for the client, then I would suggest that you look at other options, reducing the coverage. As I said earlier on, $20,000 might not sound like a lot, but if somebody were to be dealing with their recovery from cancer for a 4-month period, well, $20,000 would be $5,000 a month over 4 months. That's a lot of money to the average consumer. And remember, the average consumers are really the ones I think that we should be targeting. The ultra affluent, they don't need insurance. Now, it's our job to show them why they want it, why it makes sense, but they don't really need it. The people living paycheck to paycheck, they're the ones that desperately need it. And for those of you that are still hanging around, we've lost a few attendees, but for those of you that are hanging around, I'm going to tell you a little secret. And I'm surprised most carriers don't promote this more, but I learned this from Keith Leach. Again, kudos to Keith. The number one purchaser of CI, critical illness insurance in Canada, is a single female healthcare practitioner. And I think this is a great conversation to also have with your clients. I mean, just ask them, why do you think that is? As I'm asking you, why do you think single female healthcare practitioners are the number one purchasers of CI coverage in Canada? I think the key is in the healthcare practitioner part, in that they see this every day. They see that it doesn't matter what your income is, or your gender, or your nationality, who you support in politics. It doesn't matter. Everybody can have cancer or a heart attack or a stroke. It's indiscriminate. Some people are more likely to get it, but those people should even more so be the ones buying the coverage. And why single? Well, obviously, single individuals don't have their partner to help support them financially during these challenging times. So that would be the next group of individuals I would target if I were prospecting for critical illness insurance. All my single clients. And then finally, females, whether they're single or in a couple relationship. Females are typically more risk averse. They appreciate their mortality more than men. We often tend to think we're immortal. It's not going to happen to us. Or the other fact of the matter is women are the caregivers. And I think they can appreciate that if it were them that were to get sick, with no disrespect to their husband or their male partner, would they be able to provide all the support necessary to get through that recovery? And I think from my conversations in the past, no, not always. And that's why the money is so important. It helps relieve stress. It allows them to deal with the recovery however they want to. And maybe that is flying a sibling in, their sister, to help take care of them. Sorry, I got off track there. Let me answer some more of these questions. Does the CI include Alzheimer, dementia, and psychological issues? Yes, there's a complete list. And in fact, we are still using the 2009 definitions, for which specifically for Parkinson's and cancer, they're a little more lenient than the more recent revised definitions for the ailments that have been proposed by CLHIA over the last number of years. I think the first time was 2006 when they came out with standardized definitions, but companies have chosen to use different definitions at times, but it's pretty much standardized these days. Just wanted to double check. CI maturity is 20 years if there's no claim. So yes, for the return of premium on cancellation benefit that we offer, it is a 20-year minimum before you're eligible to surrender it. Sam says, very well, clear and wonderful, Sean. Sales questions for a great conversation to prospect. Thank you very much. You're very welcome. You're very welcome, Sam. Any other questions? Yes, Tammy says, do you have any marketing materials in regards to using your tax money for CI? You know, great question. No, not that I'm aware of, Tammy, but why don't you reach out to me separately and I'll follow up. And if anybody else is interested, again, you're all welcome to email me and I'll follow up with you with whatever marketing materials we're able to come up with. I'll be honest with you right now, for the most part, it's very much product related, features and benefits related material. But we're continuing to work on stuff, and you're welcome to have these slides as well. So actually it will be going out to you anyway in the coming weeks. And I think that is all of our questions here. Again, I'm happy to hang on here if there's anything else that I've missed. Oh, do you have, Emmanuel also asked, do you have any statistics on the percentage of premium revenue that is or was paid out in CI benefits? You know, that's a great question. No, the only stat that I do know is that there's about $1 million in premium. Is that premium? Yeah, in premium going towards CI every year. And the funny thing is, it should be dramatically more than that. But unfortunately, many policies are either being paid out or are lapsing. And it's so important for you to have a candid conversation with your clients to make sure that they're comfortable with the premium stream, because you and I both know the first expense that they're going to cancel if times get tough is probably going to be their CI coverage. And ROP only makes that more expensive. So having a good conversation with your client about when to use ROP, if it's affordable, I wouldn't I wouldn't discourage a client from buying a CI plan without ROP, because I truly believe in the value of critical illness insurance. And I think ROP is an extra added benefit if they can afford it. And I wouldn't reduce the CI coverage to afford the ROP personally. Great question, though. Not enough information on claims. I don't have that, sorry. What else? Apologize. Lots of questions coming in now. Let me go in reverse order here. Okay. Do you insure hard to insure clients? Marcia, not for critical illness insurance, with the exception of our CI rider that I talked about. They would be considered hard to insure if they've got family history, or somebody with family history would be considered hard to insure for CI purposes. But with us, if they qualify for a standard offer on our life insurance product, they'll automatically qualify. So in a way, yes, but not in, I think, the context that you're asking. What else do we have here? Oh my goodness, lots of questions. How about prospects with ADHD and taking medications? Will they qualify? So when it comes to mental disorders, yes, they can absolutely qualify. The question always comes down to the severity of the ailment and the stability of the condition. You know, if they've been on ADHD or, you know, other medications for 5 to 10 years, and, you know, they're not having suicidal thoughts, or they're not having, they haven't missed work, they're otherwise leading a normal lifestyle, then they would be considered a standard risk. It's, you know, if they're missing time off and they're having major attacks, then depending on the frequency and the recency of it, that would certainly have an impact on their insurability. You're always welcome to send me an email for a preliminary assessment. We're happy to offer those. If a client had a stroke, is it possible to get CI? Not traditional CI, unfortunately. Exclusions, I know underwriters prefer not to include exclusions. The reason is because it's just so hard to say that the ailment was necessarily caused or not caused by something. So I know they try to avoid that, especially with CI if possible. I know oftentimes we will have exclusions with regards to cancer, less so with stroke because it can happen. It can lead to other issues. What else? I think that's about it. Again, if I missed any or if there are any other questions, feel free to send me an email. I apologize, I'm looking off to the side here. That's where the questions are coming in. So once again, thank you all so much for your time. We really appreciate your support, and we look forward to doing business with you and hopefully seeing you in person in the very near future. Have a great day, everybody. Thank you very much.